I'm just going to go with that. So good morning, everybody.
Good morning.
Thank you for joining for another edition of our weekly real estate backstory. Besides all the fun setup issues we've had, we appreciate you coming with us today. So we got a lot of cool information to go over. First of all, my name is Alan Richardson. I'm the managing broker at Maximum Realty and Realtor Partners.
My name is Richardson, the compliance broker from Maximum One Realty and Realtor Partners.
And we are on the road today. So
Yep.
we started a little bit early and we are out into in our Congress office actually, because we're going to be starting our relaunch series. Goodness gracious, it's one of those days.
It's a
It's going to be
Monday,
that way all day long. So
Absolutely.
so we just kind of want to jump right off and start into the series of, the Fed hiked interest rates this past week. And so, the Fed, raising interest rates, that brings a lot of attention, a lot of, and a lot of our clients don't really understand what that means. And so, for the second consecutive time, the Fed raised the federal funds rate by 3/4 of a point, 0.75. And so right now the total benchmark rate somewhere around 2.25, 2.5, that kind of thing. And so, the Fed is trying to really kind of move interest or slow the economy down. It's kind of the intention that they have there. And so we want to talk a little bit about that, because just the fact that they raise interest rates does not mean that this is going to raise interest rates on mortgages. And so that's one thing that we have to kind of understand. And so the first thing here is that how will the rate hike affect you? So first of all, of your credit cards. So not paying off those credit card balances.
It's gonna hurt you.
It will hurt you. If you have ARMs, so adjustable rate mortgages. We've been kind of worried about adjustable rate mortgages for a while.
And we also seen an uptick of adjustable rate mortgages when the Fed started raising its rates.
Yep.
So for those of you that are in ARM rate, please have an exit strategy.
Yeah, that's a good way to put it.
Yeah.
So car loans are also highly affected by the federal funds rate. Your student loans, a lot of times those are based on the federal funds rate as well. And then on the positive side, if you could call it that, is your savings
account.
Yeah, because it
Should
would.
go up a little.
It was already a little smidgen, so it's going to go up, like pennies. So take what you can get, I guess, right there. So but
Let's put it this way: what you have in saving, the interest you earn on that does not outweigh what you have in debt and credit cards interest rates. So
And
please
so-
keep that in mind.
and that's the thing that we want folks to understand, right? And so as soon as like that big but though, as soon as the mortgage rate, as soon as that happens, guess what happened to mortgage rates? They drop like a rock, right? So like you're going, hold on. The federal, the government
Raised their interest rate.
and then we drop half or a quarter of a point on mortgages, and that's because mortgages are tied to the 10-year treasury. And so, the more volatile the market is, the more people move over into treasuries. The more they move over into treasuries, the more volatile and the more active that market is, the more those prices go up. When those prices go up, the mortgage rates go up. And so that's kind of, that's the thing, is that you can't and what we don't want to have happen is we don't want our clients to be like, oh my goodness,
Well, and also I think,
interest rates are getting worse. Well, they are, but they aren't, not for mortgages.
well, and I think also the mortgage broker are looking at it from a projectile point of view, because they know that by government raising the interest rate, it's going to cause a series of shockwaves through, United States. And therefore, the mortgage banker make money when they give out loans. So therefore, they're trying to combat that by lower the interest rate just slightly to give more incentive to first-time home buyers and other buyers out in the market, the ability to obtain a loan.
Well, and so we want to arm you with information so that you can be really, so we can let our folks know that, listen, the mortgages are not tied to the interest rate. As a matter of fact, one of the reasons why the rate dropped was everyone had already worked in a lot of these price increases. The Fed chair has been talking about this size of increase and what's going on. And so the markets really kind of expected this.
Right.
When it happened, they're like, yeah. And then we had a rally on Wall Street, the whole 9 yards that went across the road with that. So please, we need to be communicating with our clients because we are seeing interest rates are going to be leveling. They're going to be going up and down a little bit, that kind of thing. But we're kind of where we are right now. We do think long term that they'll be dropping, but we've got a little ways to go until we get past our current economic situations, kind of thing. We want to jump into a headline that we saw this past week, and when you look at the headline, it seems disturbing, right? So dramatic increase, foreclosure filings are up more than 150%, and what that tells us about the housing market. And so we have to be ready to understand that this is like our foreclosure filings up by 150%. Yes, they were so amazingly low that they're up, basically 50% from where they were, which was basically at zero kind of thing. They're the lowest it really was kind of thing. If you actually read inside the same article in here kind of thing, they're shooting up from extremely low levels. And even after a really sharp increase, it will not have any impact to the marketplace.
So the investor if I was going to start calling you and say, hey, how about a foreclosure I'm hearing on the news line? But the fact is, if you look at the chart next, what Alan has.
I mean, like you look at this and you think, okay, this is the total of foreclosures and short sales. This is what it actually looks like, and this is what they're quoting, right? And so if you look at like where foreclosures were, like look in 2010, 1,654,000 foreclosures. Okay. And so, yes, do we have 164,000 foreclosures? I don't care how great the market is. 1%. You're always going to have some level of market. So, yeah, so we are really, really low. Now, were we artificially low last year? Absolutely. There was a foreclosure moratorium, there's an eviction moratorium, all these kind of things were in place. So yes, just the normal course of things, it is going to go. There will be more, but And
I will tell you, the one that are in foreclosure typically are the one with major maintenance, deferred maintenance
issues, right?
So therefore, even if an investor pick it up at a song, there's at least a $60,000 plus rehab on that property.
See, here's the problem with the foreclosure market right here. Is that look at profits for the average home sellers again across the US. We have a lot of equity. And so I don't know anyone that's upside down in their home. Even if you bought your home right now, property values increased another 14% last month. So, I don't know anyone that's upside down in their properties right now.
Continue this way? No, probably not. I do project the increase of property value slow down to 1 digit versus a 2 digit at some point. But still, once again, wealth is built in home ownership in the United States. So
it is.
It doesn't matter if you rent for the next 30 years. Guess what? You're basically paying somebody else's debt off.
Yeah. Well, we get the rents too. But I found this slide to be very, very interesting here, and that this is the difference between the total mortgage debt versus the total valuation of all real estate.
Correct.
And so when you look at and you can see how it was much tighter in 2009, 2010, that kind of stuff. But look at how much equity. We have more equity inside the US in the housing market than we've ever had. All right. And so we're in really, really good shape on that kind of thing. We're not looking at a foreclosure moratorium. I do believe that there will be a time and there will be some people due to certain economic conditions and things like that. Well, they probably need to sell.
Absolutely.
Yeah. But do they need to get foreclosed on? No. If they sell, they're going to capture that equity, which will probably help them out. I'm not saying that they want to sell. I'm not saying it's going to be a great situation. I'm saying that there are a lot of people whose best course would be to sell and move into a lower price dwelling at that point.
Well, something they can afford, and also given a little cushion and equity to move forward.
So pending home sales fell 8.6%. And so we've been seeing a shift in pending sales moving down. But see, we have to understand that the market is moving into a more balanced market, right? So, our mindset's got to be, shift, okay, with a T, or an F, sorry, shift. Okay, we have to be ready for a shift. And we're in a shift right now, and so that's the thing that we have to be prepared for. and then looking at. So
And
right,
seller, if you
Yeah.
have a property that is deferred maintenance, don't expect that the buyer's gonna take it as is right now.
Yeah.
As a compliance broker, I'm seeing more and more repairs that are being passed through the system where the seller are making amends on those repairs.
Yep. All right, so let's look at what are the numbers that we really are seeing right now, because that's one of the things that is a kind of a telling indicator for us about what we really are witnessing. And so first thing is our median days on market are continuing to go down. So
Correct.
yes, we're in a shifting market, but that doesn't mean that like oh my gosh, Katie bar the doors, things are
Right.
things are terrible. Things are really, really good in real estate still. So, but we have to understand that we are in a flux right now. So first of all, median days on market. So good homes are going quickly for good price. So, that's going to be the big thing. We are seeing a difference in the different price points right now as far as
Anything less than 300, still slightly seller's market. Anything
it's on
above
fire.
300, it may, depending on the property, where it sits, the
Yep.
condition, and what it offers, may be a seller and buyer's market.
So, this shows the share of homes selling under a month for the past 5 years, and you can see we're still at one of the highest levels
88%.
ever. Yep. Average number of offers received on most recent sale. So now we've seen a drop of about 2 offers.
Correct.
So the average was running about 5.5. And so now we're seeing that we're getting about 3.5 offers per listing. So are we seeing where demand is waning? I don't really see demand waning. I see that pricing is pushing people into certain areas.
Correct.
Kind of thing. And value is one of the biggest challenges that we have.
And some buyer, unfortunately, it's not that they're unable to buy, they're just unable to buy at that price point. And so now they're having to sit back, basically either buy down points or what have you to move forward with a higher purchase.
So the next thing is this one I found very, very interesting and this is the number of buyers that waive their inspection or waive their appraisal. So these are the folks that are waiving, and it's not going down, right? It's going up. And so we are seeing that still, but now where we're seeing the vast majority, as Ming was saying, is under the $300,000 price point, at least here in South Atlanta. On that, sorry, we have a phone going off in the background, so I apologize about the bad to the bone in the background there.
It is bad to the bone.
Yeah. On the day we were born. Yeah, that's it. Now, our shares of all cash buyers, that's dropping. Thank you. And so we're actually glad to see that. So the share of cash buyers has been going down. We've seen that, all cash offers being like we're seeing more FHA, we're seeing
I actually saw DPA the other day.
and we're seeing DPA. So we're really glad to see that. Yeah, absolutely.
That the sellers of the DPA program. So yes, kudos to the agent.
Yep. Now, and so our first time buyers, however, are still really suppressed. You can see back in 2008, 2009, 2010, first time buyers really shot up into our market.
53%.
And so we've been, realistically, if you look at just the demand we have, first time buyers should make up about 40% of our market. That's why we're seeing so much price pressure on properties under 300,000.
So right now it's only 30%. So what that means, 10% of this buyer has been dropped out of that range simply because inflation of the property. So
let's talk about inventory here, because if you look at this graph and you think if you were to zoom in on just the 2022, you would think inventory levels were just shooting up. But when you look at inventory levels based on historic, this shows the last 20 years on inventory level. We're still at one of the lowest inventory levels we've ever been. And so, is inventory improving? Yes. Are we really glad to see that?
Absolutely.
Yes, we absolutely are. I understand that, we may not like it, but we have a housing shortage. So here in Georgia, we have a housing shortage of around 120,000 households. The challenge is even in our best year, we build about 50,000 houses here in Georgia. So we're still, and that's saying that, we didn't have a lot of people moving in the state, a lot of millennials moving in first time buyer age, which we all do. So we're still 3 or 4 years from being able to equal out our housing shortage here in Georgia. That's going to really continue. Now, as far as like really local numbers that we have, so this is from Georgia MLS, and so our new listings, we are seeing where new listings, for this, actually
Slightly dropped.
right? Everybody's like, inventory is shooting up. Well, but the new listings are kind of down. Now, we're also seeing where our pending listings, like we talked about, pending sales are trending down. Same thing we're seeing nationally as well as here in Georgia. However, the volume of closed, so the total number of sales
Dollar
closed,
about
no,
dollar,
no.
not unit, right?
Units, yeah,
The unit.
yeah.
My apologies.
Units are down, but look at dollars. So this is dollars, and so you can see that the number of units here in Georgia, we're running around 10% less on the number of units. We're running around 14% higher on property values. So yes, our sales, the number of sales are down by about 10%. However, the average sale price is up about 14%. So for most realtors, it's a wash to a positive on that side of things.
Well,
So yeah,
for the realtors, the one are actually having transaction is a great day, but overall volume, there's less to go around, I guess, in that aspect.
And so you can see that this is our total number of active listings. So our total active listings are going up. But see, when our sales our number of sales are going down, is it that our inventory is really going up, or is it we're just selling less homes? So, that is a very, it's one of those head scratchers for you a little bit right there. Our average days on market is actually under last year. So, and again, this is from Georgia MLS. I just pulled this data yesterday. So it's really, really active information. You can kind of see that, as far as our active listing trends, yes, we have more total listings than we've had for the past year kind of thing. But it's not, I mean, if you look at September of last year was 27,000. We're sitting on 31,000 in July. So, we're right in that same ballpark as far as that goes. National Association of Realtors, they kind of released what their 22 and 2023 forecast. And so they're looking at nationwide, the total number of sales being down about 13%, but home prices being up about 11%. Again, kind of a net wash when it works out. And they're looking at, for the 2023, unit sales being flat. So actual sales being flat with a 2% price increase. And I think that we kind of united on that. We see us somewhere in that 3 to 4% property value appreciation continuing. We still have a lot of demand in here.
And it's going to be very interesting come September. I think that's going to be an indicator how the rest of the quarter moving into 2023 will reflect.
Yep. So for my realtor friends out there, there's a lot of news going on. There's a lot of things happening. As far as like, what are the things that matter and what are the things that we can control? Yes. Does the economy matter? It sure does.
Absolutely.
But no one's asking my advice, and I don't pull, flip levers and pull the triggers on that. So what can we focus on? There's things that we can focus on in our business.
And that is things you can control.
I thought you were bumping me, you're just shaking a leg. Okay, gotcha. All right. Well, now one thing that we do see is a potential area of concern as well as a potential area for opportunity, and that's going to be in rental. Rental rates are continuing to accelerate. We are going to see prices flattening off on the purchase area. I mean, over in property values, going to start leveling off. Rents are not leveling off, right? Because rents continue to accelerate over the course of the next year, because as people renew that kind of stuff, rents continue to increase. And so, some of your really large rental companies kind of thing are anticipating, long-term rentals. They've captured about 30% value increase in rental prices over the last 2 years and are continuing to plan on that moving forward. They're all buying more and more properties.
Every month.
At the same time, rental vacancy rates are the lowest it's pretty much ever been.
Yep.
Rental vacancy rates are really, really low right now. There's a lot of demand.
It spiked up on 2021 at the end of the year is because the moratorium went off, and therefore a lot of landlords were doing what I call clean house and basically get rid of the renter that was not paying.
Yeah. Now, this is from CoStar as far as what are the renter households looking to rise. We're looking at rental households continuing to rise. And so, for me, that is concerned, because I know that for the health of our economy, for the health of just Americans in general, and if you want to help someone move into a position of wealth, it comes through home ownership.
Right.
Right now, nationwide, we continue to have rent spikes. It is slowing from that record pace, but you can see that right now the monthly mortgage payment is about $1,800 versus,
That's a
for
lot.
a 2-bedroom, it's about $2,000. Overall, it's almost a net wash if you look at the overall for rent versus own. And so, but at the end of the day, if you rent for the next 5 years or you own for the next 5 years, your long-term profitability and your long-term wealth is a very different picture.
It's a negative.
And so we need to be able to talk to folks about that. That's one of the things where, I know that, I mean, the thing that we're really saying is, marry the house, date the rate. We are going to see rates in the future moving down, maybe not in the immediate future, but they will be moving down in the future. Refinancing it later on is going to be the way to go on that point. But we're not looking at property values dropping. We're looking at property values continuing to increase. So a couple of things that the National Association of Realtors did some surveys and some studies, and I found some interesting information. First one is that for your buyers, around 14% of the buyers are buying property based on virtual tours, showings, open houses only.
This is why GAR came out with a special step on sight unseen, and where I will highly recommend all the realtor out there to use that special step, just because to protect your asset.
Yeah. So right now, remote work is really continuing. Like a lot of businesses want the workers to come back, but a lot of the workers don't want to. So right now, we as far as like the total purchases, around 85% of purchasing is happening outside of city centers. And about a third of our buyers, they want work from home features. So for listing agents, these are important things to be highlighting. Like why are we, like what are the features that buyers are really looking for? Work from home features. Those are a really big deal. One other area where they just released is that this is the belief of the typical buyer on how much down payment. So around 21% thinks it's somewhere between 6 and 10%. 35% say it's 16 to 20%. A third of our buyers say that they have to have 16 to 20%. Another 10% it says you need more than 10%, more than 20% to buy. Well, that's not true. What are the numbers? So for our average first-time buyer, they pay on average 7% down payment. For our average repeat buyer, they pay on average 17%.
That's because they're buying down the rates sometimes. And also not get away from the PMI.
But the repeat buyers, those are folks who are bringing equity from their previous home to them. So, that's the thing. And so for our average first-time buyer, it's 7%. So this week, I'm going to be, we have our relaunch series starting here in our Conyers office. So today, Wednesday, and Friday, I'll be doing all the different relaunch classes. So it's going to be today's lead generation, Wednesday's real estate technology and marketing, and Friday is business planning. We're also teaching these classes virtually, not for the relaunch, but for the CE. So we hope you guys have a great week. Thank you.
Have a great day. Happy Monday.
Good morning.